those who have used their superannuation or their accumulated superannuation benefits to commence an account-based pension, whether you've retired after the age of 60 or attained retirement age, which is 65, there is a minimum amount that you need to take from your superannuation account each financial year. Now, the minimum amount or the drawdown rate is the amount that needs to be paid out within the financial year and is dependent on your superannuation balance, but then also the drawdown rate is determined based on your age. The whole purpose of superannuation is to fund retirement. The reason for the minimum drawdown rates coming from the superannuation system or coming from your superannuation balance each financial year is that the government wants us to fund our retirement, rather than it actually being just untouched entirely and left there as an inheritance to go to the next generation. Now, depending on the type of superannuation fund or the superannuation structure that you might have, this may make a difference to the way that the superannuation minimum pension payments are processed accordingly. In particular, with APRA-regulated superannuation funds such as Master Trust or industry superannuation funds, these are generally all automated on your behalf. So the superannuation trustee, they take responsibility and they calculate automatically your minimum pension payments for that relevant financial year. Alternatively, on the other hand, is self-managed super funds or SMSF structures. A little bit different with self-managed super funds or SMSFs, where the process requires a manual calculation, often with the assistance of an accountant, and the SMSF trustees, which are often the members of the fund themselves, they have to ensure that they do take the minimum pension payments each financial year, which is a little bit more manual than the APRA-regulated superannuation fund option. Where things can get a little bit ugly or a little bit different with self-managed super funds is if the trustees or the members of the superannuation fund do not meet the minimum requirement or the minimum pension requirement for that relevant financial year, then the self-managed super fund might lose its concessional tax status on tax-free earnings and tax-free on capital gains tax as well. Now, just because you have to take a minimum each financial year, it doesn't mean that's the only income that you can take from your superannuation fund, whether it be an APRA-regulated superannuation fund or whether it be a self-managed super fund. Once you have met a full retirement condition release, whether after the age of 60, you have ceased a position of employment and you have used your accumulated super benefits to commence an account-based pension, or whether you're still working full-time and you reach age 65, which is an automatic retirement condition release, you have full access to your superannuation benefits. So although the minimum pension payments must and automatically will be paid depending on what type of super fund you have each financial year, if you have an account-based pension, it doesn't mean that is the only income that you're restricted to. You have full access to your money, whether your minimum pension payments is $60,000. Again, if you've met a condition of release and you've retired or you've hit retirement age of 65, your minimum doesn't have to be $60,000 each financial year. If to live your ideal lifestyle in retirement, it's $80,000 a year, you can draw an income stream of $80,000 a year, whether it's paid on a monthly basis, whether it's paid weekly, or whether it's paid via a lump sum withdrawal before the end of financial year is finished. On the contrary, if you find that you are not spending the entire amount that you are withdrawing from superannuation, or if your superannuation fund is paying you more than what it financially means to sustain your lifestyle in retirement, you can actually roll back a portion of your account-based pension into accumulation phase. Now, there are some things to consider, particularly around a tax consideration, is that you're going from one environment in an account-based pension where earnings and capital gains tax are all tax-free, whereas if you revert a portion of that money to ensure that you're drawing the right amount from superannuation to fund your lifestyle and retirement, you're going to a taxable environment within accumulation phase. And what that taxable implication looks like is on any investment earnings within accumulation phase, it's getting taxed at 15%. So any investment income on bank deposits or interest earned or dividends is all taxed concessionally at 15%. If you sell any investment options, if you switch from a conservative to a balanced or from a high growth to a moderate, and the fund and you've held the asset for longer than 12 months, then there's capital gains tax at 10%.